What we're analyzing today is a really distilled report. It's focused entirely on Plug Power's critical $400 million financing deal. And it details the impact on their debt, the market reaction, and, what this means for future price targets.
Yeah.
What jumps out right away is just how focused it is. The writer clearly knows the key data points, the interest rate savings, the cash runway, and just gets straight to the point. Very action-oriented.
I agree. You can feel the expertise. They understand the existential urgency the company was facing, and they really hit the nail on the head with the importance of this deal.
Right.
But I think for a piece that's tackling such a huge change, we need to make sure the presentation itself maximizes its analytical weight, its credibility.
So let's look at how the magnitude of this news is being framed, the tone.
Yeah, that seems like the perfect place to start. If the tone is off, a reader might just dismiss the data, no matter how good it is.
Okay, so the material's overall impact would be magnified by slightly recalibrating the intense, high-stakes language to ensure maximum analytical credibility.
Mm-hmm.
The material uses these really charged phrases like massive development, changes everything, and it calls the old debt toxic.
Right.
And that immediately signals a really strong, maybe overly bullish bias. It risks pushing away readers who are looking for purely objective analysis.
That is such a critical observation. The writer is clearly excited, and they should be, but they've chosen emotion over measured analysis to communicate why it's important.
Exactly.
When you use a word like toxic, you're telling the reader how to feel about the past instead of just showing them the facts of the new situation.
Yeah, you're doing the emotional work for them.
Right. And that might push away, say, an institutional investor who really prioritizes a cool, calculated assessment of risk.
That's the key distinction, isn't it? The difference between reporting dramatic news and using dramatic language to report it. And for financial analysis, you want the first one. The numbers should do the talking.
Absolutely. Think about the reader who's been following this company. They know the risk. They don't need the writer to underscore the anxiety they've already been feeling.
A really good point.
The material should reframe the narrative to highlight the solidity of the solution, not the drama of the risk. Just let the numbers, that massive gap between 15% and 6.75%, generate the excitement.
So how do you do that without making the news sound, mundane? Because this is a huge deal for them.
It's about swapping out the sensational adjectives for precise financial language. The fact that they ditched a 15% interest rate is extraordinary on its own. You don't need to add hyperbole to it.
Okay, so I've got some concrete examples here. Instead of the emotional phrase toxic debt carrying a massive 15% interest rate, you could use objective terminology.
Like what?
Something like high-yield, pre-existing 15% interest rate debt. It keeps the accuracy of how high that cost was, but the tone is just more professional.
That shift is subtle, but it's powerful. It signals to the reader, I'm giving you financial reality, not my personal opinion.
Right. What about the part where it says this removes the immediate bankruptcy risk?
That's another area where just a little more precision adds a lot of credibility. The statement is probably true directionally, but the phrasing is too absolute.
For financial analysis, yeah.
So we'd suggest replacing that dramatic phrase with something more factual, like significantly de-risks the short-term balance sheet, providing a secured financial runway through 2026-2027.
Oh, that is infinitely stronger. It shifts the whole narrative from, a declaration of victory to a sober assessment of their improved liquidity.
Right.
And that's so vital for a company in a capital-intensive space like green hydrogen. You have to show you're being responsible. It's the difference between sounding like a cheerleader and sounding like an expert analyst. That second phrasing is analysis.
Exactly. It uses the right language, de-risks the short-term balance sheet, which is precisely what this kind of financing does. We want the tone to match the seriousness of the financial engineering.
And that actually leads us right into our second point. We've established this was great financial engineering, but now we need to anchor it in the company's long-term reality. To fully establish the long-term significance of this $400 million, the analysis needs to contextualize the new 6.75% debt rate against the company's continuous capital needs and its path to profitability.
Okay.
The report is great at showing the immediate short-term win. They got rid of that crippling 15% debt, they've got 2 or 3 years of runway, but it kind of stops there.
Right. It leaves you wondering.
It does. It leaves you wondering. What does Plug Power need to achieve by 2027 to make this 6.75% rate worth it? Or is this just kicking the can down the road to the next refinancing event?
That is an absolutely essential question. The market's reaction isn't just about immediate survival. It's about whether this buys them enough time to actually execute.
Exactly.
Because if they're back at the market in late 2026 needing more cash, then this fix was, well, pretty temporary. The analysis says the balance sheet is fixed until 2027, but that's only as good as the operational progress they make between now and then.
So the analysis defines the starting line and the length of the race, but not really the finish line, not the milestones that prove this was a good investment.
That's the crux of it, yeah. A 6.75% convertible note still has to be paid back or converted. If the company is still burning cash in 2027, this just postpones the problem.
So what's the suggestion?
The material has to anchor this financial fix to operational milestones. This $400 million isn't just a defensive lifeline. It should be framed as the funding needed to hit critical goals.
Like what kind of goals?
Like completing their green hydrogen plants or hitting specific FCEV revenue targets. The things that are required to make that 6.75% coupon sustainable in the long run.
You have to connect the funding to the execution. I mean, the writer highlights the analyst price targets, $4, the more bullish $7 model.
Right.
But those targets are based entirely on them achieving operational scale, not just surviving. So if you don't explicitly link the $400 million to those goals, the price targets just feel like they're floating out there.
For sure. Investors want to know, how many quarters of cash burn does this cover? And what has to be achieved in those quarters? Is this money for delays at the plants, or is it just for working capital? If that's not addressed, the analysis feels incomplete.
So we can strengthen this pretty easily. After noting that runway to 2026-2027, the writer could just add a brief sentence about the future in A. Something like, the critical context here is whether the current burn rate allows this financing to last until operational scale is achieved, or if further financing is projected to be necessary prior to 2027.
That kind of framing shows a much more sophisticated understanding of a growth company's needs. It changes the question from, did they survive, to did they buy enough time to thrive?
A much better question to be asking.
And we also need to see this capital connected to immediate targets. For instance, just briefly mention how this money helps them meet specific Q4 or 2025 milestones that validate that path to $4 or $7.
It's really just about raising the analytical ceiling of the report. The writer clearly has the financial knowledge to do this. It just needs to be woven into the story.
And if they do that, the whole thing feels less like a temporary relief and more like a pivotal strategic move.
Which brings us to the structure of the report itself. I feel like this piece is trying to be everything to everyone, the fundamental investor and the technical trader.
And that creates some whiplash.
It does. So the material attempts to serve two distinct audiences in a single compressed paragraph, and that creates a structural dissonance.
Yeah.
The flow just abruptly shifts from fundamental analysis, interest rates, debt, balance sheets, to super-specific short-term trading jargon. Things like V-shape recovery, bear trap, and a breakout above $2.15. That rapid shift can really fragment the focus, especially for someone who only cares about the long-term viability of the company.
I totally get why the writer did it. They're trying to give a complete picture. But you're right, it confuses a reader who only cares about one of those things.
Yeah.
The person doing a deep dive on the convertible note and that 6.75% rate is thinking in a 5-year time horizon. They're looking at solvency.
Long-term.
Exactly. And when you immediately pivot to talking about a bear trap and some intraday price level, you're forcing their brain to switch from corporate strategy to day trading. It's jarring.
It absolutely is. The weight of the balance sheet news gets diminished because you're immediately pulled into short-term speculation. The technical part is good, but where it's placed undermines the fundamental news.
For sure. I mean, the analysis of the short squeeze, the reaction to dilution fears, the V-shape, that's all essential for a trader. But for the institutional investor analyzing the future of the hydrogen economy, that's just noise. It's almost a distraction.
So what's the fix?
We need to improve the clarity by segmenting the analysis. The core financial deal and the analyst valuation models, that's one thing. That should be totally separate from the immediate short-term trading signals.
That makes sense. That separation acknowledges that you're serving two different needs. It gives each audience exactly what they're looking for.
Right, without making them wade through details they don't care about. And the fix is purely structural, which is great because the content is already solid. We're just asking to resequence it.
Exactly. Since it's currently one big paragraph, just a simple two-section split would make a world of difference.
we'd suggest restructuring it into two clearly marked sections, maybe with a short sentence to introduce each one.
Okay, so let's detail that. How would that first section be defined?
So, Section A would be the fundamental focus. This is the deep dive. The debt payoff, the new 6.75% rate, the interest savings, the runway.
Okay.
And crucially, this is where the long-term price targets, the $4 and $7, and that connection to operational goals would live. It's the whole story on long-term viability.
Perfect. That gives the long-term folks the context they need. So then, Section B.
Section B is the market action focus. This handles the immediate volatility, the trading signals. This is where the writer explores the market reaction. That initial dip on dilution fears, the bounce, the V-shaped recovery, the short squeeze mechanics.
And the technical levels.
And all the technical breakout levels, yeah. The 215, the 250, the $3. This becomes the actionable guide for traders. But it's only presented after the fundamental case has been made in Section A.
That approach respects both audiences. It transforms the report from, like you said, a mixed signal into a comprehensive, multi-layered resource. That change alone will improve the clarity immensely.
I agree. This material is super useful and timely. The opportunity is just to refine the presentation to match the quality of the analysis.
So, to quickly summarize the three core areas of feedback. First, we talked about calibrating the tone, moving away from hyperbole like toxic debt to build credibility, and just letting the numbers that drop from 15% to 6.75% speak for themselves.
Right. Second, we stressed expanding that long-term context. It's about framing this $400 million not just as a temporary runway, but linking it directly to the operational milestones they need to hit by 2026 or 2027 to actually become profitable.
Make it strategic, not just offensive. And third, that critical need to structurally separate the fundamental analysis from the short-term trading signals. Creating distinct sections for the long-term case and the technical levels just prevents confusion and makes both parts stronger.
Those are three key actionable steps. Revise the language, link the capital to operational goals, and reorganize the technical data. I think implementing those will really maximize the impact of this crucial update.
It's a really robust starting point, and we genuinely believe these revisions will elevate the report significantly.